Hello YouTube, welcome back to my channel. Today we're going to learn about what forward rates are and about a derivative called a forward rate agreement. Okay, so let's first learn about what forward rates are. A forward rate is a term used in both fixed income and currency trading to describe the current expectations of future bond interest rates or currency exchange rates. In fixed income or bonds, the forward rate is calculated based on interest rates for various maturities. These rates are usually plotted on a graph as a yield curve. If an investor wishes to invest their money for a year in bonds, there are a few ways of doing that. They can buy a one-year bond and hold it for the year, or they could buy a 6-month bond and as soon as that one matures, buy another 6-month bond. Under these two scenarios, the investor knows the interest rates for both the one-year bond and the first 6-month bond. They don't know the actual interest rate for the second 6-month bond that they will eventually buy because it's in the future and interest rates can change between now and then. The forward rate, thus, is the predicted interest rate on the second 6-month bond that would allow the investor to earn the same amount of interest under either scenario. Forward interest rates are watched closely by investors as economic indicators in currency markets. The forward rate is the agreed upon rate at which the parties will exchange currencies on a future date. These contracts are used by large companies to hedge against currency fluctuations. Okay, so now we know what a forward rate is. It's just an interest rate implied for periods of time in the future by zero coupon bonds. For example, the market implied yield on a 3-month Treasury bill 3 months from now is a forward rate. If we know what the 3-month zero coupon Treasury bill rate is and what the 6-month zero coupon Treasury bill rate is, we can back out what the market is implying as the yield on a 3-month Treasury bill 3 months from now. To calculate forward rates, we just need the zero coupon yield curve. Here's a forward rate calculation example taken from my book, Trading and Pricing Financial Derivatives, which is linked to in the description below. Suppose you have a 2-year bond yielding 3% and a 1-year bond yielding 2.4%. If you bought the 1-year bond, how much would you have to earn on a 1-year bond in 1 year's time to have earned the same amount of interest as you would have earned by just buying the 2-year bond? $100 invested in the 2-year bond would give us 100 times e to the 3% times 2 for 2 years, or $106.18 after 2 years. In order to get the same amount of money by buying 2 consecutive 1-year bonds, the year 2 bond would need to pay us 3.6%. $100 times e to the 2.4% times 1 times e to the 3.6% times 1 gives us $106.18, the same amount of money. So the 1-year forward rate, starting in 1 year's time, must be 3.6%. Okay, so now that we know what a forward rate is, what is a forward rate agreement? A forward rate agreement, or FRA, is an over-the-counter agreement to borrow a fixed amount of money at a fixed interest rate at a specified future time period. In plain English, it's an over-the-counter agreement to borrow or lend during a specified time period, not starting now. Banks and large corporations can use FRAs to hedge future interest rate exposures. The buyer hedges against the risk of rising interest rates, while the seller hedges against the risk of falling interest rates. Speculators can use FRAs to make bets on future changes in interest rates. Rates in the future will usually be different from the implied rate at the time you entered into a forward rate agreement, giving rise to gains or losses on the agreed transaction. Suppose you agree to lend $100 million for a 6-month time frame starting in 2 years to earn a 3.5% return. 2 years passes and it turns out that the market rate for the next 6 months is 4%. This means you have a loss on your original trade because obviously you could have invested at 4% while instead you're investing at 3.5%. Your cash flows will then be, at the end of the 2.5 years, 100 million times 3.5% minus 4% times 0.5, giving us a loss of $250,000. Hopefully that all makes sense to you. If you found it useful, hit the like button. If you want more content like this, hit the subscribe button. Tune in tomorrow when we're going to learn all about interest rate swaps. Have a great day. Bye.